A recent survey by Iris Software has revealed that at least 50% of self-employed businesses don't feel ready for MTD for ITSA. In our experience, this is possibly a little optimistic.
We're not even sure if 50% of self-employed businesses are even aware of it, let alone ready for it. So what exactly is it? And how is it likely to affect us?
Making tax digital as a concept has been with us since April 2019 and introduced far stricter reporting requirements for VAT-registered businesses, requiring them to submit their VAT returns using only accredited software as opposed to simply completing a VAT return manually or via the HMRC Government Gateway. Making tax digital for income tax and self-assessment extends this, way beyond the requirements of the original directives. Making tax digital was only applicable to those businesses who were registered for VAT. MTD for ITSA widens the net considerably and is set to eventually replace the existing self-assessment tax system. So what are the current requirements? Currently, taxpayers with a turnover of more than £50,000 will be required to join MTD for ITSA, with effect from April 2026. From April 2027, the qualifying income threshold is reduced to £30,000 per annum. Finally, under current proposals, from April 2028, the qualifying income threshold will be reduced down to £20,000. At this point, it is likely it will encompass the majority of UK self-employed businesses. So, for the purposes of MTD for ITSA, what constitutes turnover? The turnover test is applied as follows. The calculation is based on total turnover/gross income, not net profits. Only gross income from self-employment and property are included. These are added together to calculate qualifying income. So for the 2026 to 2027 tax year, if you have £30,000 of self-employment income and £25,000 of rental income, then the combined figure of £55,000 will be over the £50,000 threshold, meaning you will need to register for MTD for ITSA. Where income is earned jointly, then only the individual taxpayer's share of joint income is included. Where the qualifying base period is not 1 year, the income must be apportioned on a fair basis in order to calculate equivalent turnover, with the obvious basis being pro rata. HMRC will use your previous year's figures in order to determine whether or not MTD for ITSA will apply to you. MTD for ITSA is due to replace the existing self-assessment taxation system. In order to comply with the new system, if applicable, you will need to do the following. Create digital records for all your transactions. Use specific HMRC accredited software to submit details of your business income and expenditure on a quarterly basis. Submit the final declaration annually. This will effectively replace the existing self-assessment tax return. Unlike the current self-assessment tax returns, MTD for ITSA returns will need to be made quarterly, in much the same way as VAT returns are now. Unfortunately, submission deadlines will also be much akin to those of quarterly VAT returns. Under existing self-assessment regulations, our completed self-assessment return for the year ended 5th of April is not due until the following 31st of January, effectively giving us up to 9 months to do so. Under the new scheme, quarterly returns will be due on the 7th of the following month. So, for example, the quarter ended 5th of April will be due for submission by 7th of May, just a month later. The quarter ended 5th of July will be due by 7th of August, and so on. Quarterly returns under MTD for ITSA will only include income and expenditure from self-employment and rental income. So we will, of course, still need to submit details of other income, such as bank interest, pensions, and dividends. This will be done annually as part of the New Year End tax return, which you will complete once all quarterly returns have been submitted and finalised. MTD for ITSA requirements will likely come as a real culture shock to many, especially those whose current financial records are, basically, a pile of bank statements and a big bag of receipts. We can claim exemption, but only in certain situations, where it isn't practical to maintain and submit digital records due to such factors as age, disability, or location, or if it is incompatible with your religious beliefs. At the moment, the current exemption list also includes partnerships, trusts and estates, anyone with power of attorney, entertainers or sports people who are non-UK resident and have no other UK income, taxpayers with no UK national insurance number, Trustees of charitable trusts. Taxpayers claiming qualifying care relief for that source of income only, for example, foster carers. Taxpayers who claim married couples allowance or blind persons allowance. Lloyd's underwriters, religious ministers, distributions to shareholders in property investment trusts or participants in open-ended investment companies. MTD for ITSA represents a significant and potentially daunting change in the way small businesses will report their income. Reporting requirements will be far more stringent and deadlines effectively reduced from 9 months to just one single month. If you think your income might be above the MTD for ITSA threshold and you're unsure how to proceed, then we would, of course, be happy to talk it through with you to work out the best way forward. Thank you for listening, and as usual, if you have any questions, you know where we are.